Hello class, this is Dr. Fenton. In Chapter 4, we're going to talk about cost accumulation, tracing, and allocation. Now, to me, the material in this chapter is a little bit more difficult than the previous chapters. We're going to get in more to cost allocation between departments in one store and one business, and we're going to talk about allocating cost in the production area. So this is, again, more complicated, so watch my video here and then go back and read the chapter yourself. So let's get started. Now, just a quick example here at the beginning. We have a baseball team, and they're thinking about giving caps out to people. And they're going to give out, looks like 4,000 caps, baseball caps. And they want to know, how much is this going to cost us? Because if they advertise that they're going to give out baseball caps, they're hoping more people will come to the game. Well, they want to know, how much would this cost us? Well, there are three different areas of cost they decided to keep up with here. The cost of the cap itself, the cost of advertising, and the cost of labor. Someone has to be there to, unbox the caps, hand the caps out, and so forth. So what would be the total cost? Just to shows you that we can accumulate various costs to show the total cost of this activity. So the cost, if the caps cost $2.50 each, and we have 4,000 baseball caps we're going to give out, that is $10,000. Advertising, if it's $100 per unit, and we put 50 advertisements out there, maybe in radio and newspaper and so forth, that costs $5,000. And the cost of labor, if it's going to be $8 per hour we're going to pay, and looks like we're going to use 100 hours of labor, it's going to be $800 in total cost. So the total cost of this promotion idea looks like it's going to be $15,800, and management is hoping that it'll produce revenues of more than that. Now, let's look at this income statement. We're going to be working with these numbers for the next several pages. So here we have a store, and it has women's, men's, and children's departments. And they're thinking about, how can we, encourage better performance from the managers of these departments? Let's give them a bonus. Well, first they decided to give a bonus based on just sales revenue, not profit but revenue. Well, if you read this, it says that didn't work out very well. So now they decided to give the bonus based on profit of each department. So that will encourage managers to not only generate revenue, but also control their own cost. So again, what we're going to do is from sales commissions on down, all this, we're going to allocate these costs in one way or the other to the different departments. So here's the income statement. I might refer back to this from time to time. But we're going to see all these numbers again over the next couple of pages. The first thing we need to do is to identify direct cost versus indirect cost. Direct costs are much easier to trace and apply to a certain department than indirect cost. The direct costs will be the ones that only affect that department. So, here they went through all the cost numbers, even from cost of goods sold, and then all the ones I pointed out earlier, and they found out that these costs here belong only to these three departments. So none of the sales commissions in the women's department here apply to the men's department selling the women's clothes. And so this is how we divide up the sales commissions. Same way with the manager salaries. The manager salary in women's should not be allocated to the men's department. Okay, so these are all direct costs. Depreciation will be on the displays and so forth they have in each of their departments. So these are the direct costs. Easy to allocate, easy to assign. So we've handled this. Now, we need to allocate these indirect costs. For example, let me pick up like the rental fee for the store. If it costs $18,400 per month to rent the store, well, these three departments all get use of that. They're all in the store. So we need to allocate somehow the rental cost for the whole store to the three departments. The same way with all these other costs, even down to supplies. How do we allocate these to the various departments? These are indirect costs, we have to find a way to allocate those, hopefully fairly, to the 3 departments. Next page. Okay, we have, common cost. Those are sort of the indirect costs, cannot be easily traced to a specific object like a specific department. You can read the definitions on the other. Controllable cost will be costs that can be influenced by a particular manager's decisions and actions. And cost allocation is what we're going to do in just a minute. Allocate those indirect costs to those various departments. Now, just a little example here. Look what Southwest Airlines will do. Back in their 2017 annual report, they went through the calculations in detail enough to say that to fly 1 passenger 1 mile, it cost them 11.4 cents. Of course, they had 153.8 billion passenger miles, but overall, it cost 11.4 cents to fly 1 passenger 1 mile during that year. Let's get back to our example. So here's the rental fee again I just talked about. So it cost $18,400 to rent the entire store. What would be a fair way, to allocate that to the various departments? One way would be square footage. If your department is larger than my department, then you should have more of the cost allocated to you. That's what they're doing here. So here's the rental cost per month. Here's the amount of square footage. Divide. And so we're going to allocate this based on 80 cents per square foot. Now take the 80, drop it here. So the women's department, if it has 12,000 square feet, let's take 12,000 times the 80 cents per square foot and allocate 9,600 of the 18.4 to the women's department. Same thing with the men, only 7,000 square feet, 5,600. Children's department, only 4,000 square feet, 3,200. So there's how we allocate the 18.4. This is an indirect cost to these 3 departments. No one department controls all the rental cost. They're all under the same ceiling, same roof. So some people would say this is a fair way to allocate the rental fee of the store. Let's base it on square footage. Okay. So we take the 18.4, divide it 3 ways. Again, not equally, because some departments have more square footage than the others. And what about the utility cost? You might want to do the same thing. You might decide for your company that yes, utility cost usage is based on square footage. So let's take the utilities cost for the month, divide by the square footage, and get 10 cents per square foot. Now, use the same square footage for each department, now times 10 cents per square foot for utilities cost, multiply across, and you can see now how we divided the $2,300 in utilities cost. Okay. I want to go back a page to show you the utility cost and the rental fee, so we won't get lost here. See, here's the rental fee, 18.4. Here are the utilities. So what we're doing is going through all these indirect costs down here, well, from rental fee on down, we're allocating these to the 3 departments. These other costs up here were direct costs. They went straight to those departments. These are indirect. So we need to find a way to allocate these costs. So we've done 2 of these. Okay, so let's see. We've done that here, utilities, and here's an example you can read. Go to the next page. Now, a lot of reading here, but let's jump down to the main part. How are we going to allocate the $900 in supplies to the 3 departments? Well, this company decided probably supplies are used based on total sales in each department. So total sales for the whole company, $360,000. Divide that by the supplies cost of $900, and we have 0.0025 of a dollar is the allocation rate per sales dollar. Sort of an odd number here, but a very small number, supplies cost, divided by a very large number, total sales. So the rate is 0.0025 of a dollar. Use the number here, times the sales, went back into the records and found out here are the sales in each department. They add to 360. And now here is how we're going to divide the supplies cost, $900. Again, more is going to the women's department because they had more sales than the other two departments. And let's see, advertising, we're going to allocate this again based on sales. So we had $7,200 advertising cost, divide by that by total sales, and get 2 cents per sales dollar. Take 2 cents times sales in each department, and that's how we allocate the advertising to each department. These are indirect costs, but every department benefits from these. And so this business and each business will make its own decision on what kind of cost driver. And a cost driver is back up in the definitions. That is a good way to measure this activity causes this cost. So a certain activity, in this case sales dollars, maybe was influenced by the advertising cost. So that's how they decide. Companies can use different methods here, different allocation bases. So anyway, that's how we divide it up. And I think, the store manager salary, one more. One store manager, 3 departments. They decided, well, this person oversees all 3 departments sort of equally. Let's just divide that person's salary by 3 and allocate it equally between the 3 departments. This is an expanded income statement by department and total. We saw all this before. We started with all these numbers. Now we allocate all these to the various departments. Some are direct cost. I think down through depreciation, these were direct cost. The cost of goods sold, sales commissions, each department's manager salary, and depreciation. Those are direct costs. And now we use an allocation base to allocate these other indirect costs. This was the simple one to just divide by 3. But remember, the rental fee for the store and utilities, these costs are allocated based on square footage. Advertising and supply costs were allocated based on sales dollars. As I've already said, each company decides what it thinks is the best way to allocate these indirect costs. Okay, so there's no set method you have to use. There's an example you can work through yourself. Now let's get away from the retail area and get into manufacturing. Okay, and so remember back several chapters ago we talked about overhead cost, and there are 3 costs in the manufacturing area. Remember, direct materials, direct labor, and then manufacturing overhead. So materials, labor, and overhead. Materials and labor are fairly easy to trace to different products that you're making. Overhead, though, accumulates a variety of costs. It can be the depreciation of the factory building, utilities in the factory building, all kind of shop supplies, cleaning supplies. Also indirect materials such as glue and small items you use in the product itself. So we have a lot of items in overhead. We have to find some way though to allocate that overhead to the products that we're producing. Okay. In this example, it looks like we have 4,000 chairs being produced in the most recent year and 1,000 desks. Okay. We have $60,000 of indirect materials. Now, their indirect materials are part of the overhead cost. And up here they say the indirect materials will be glue, staples, screws, nails, varnish. These are items that do have a physical presence. Yes, you can touch these and so forth, and they go into the finished product. But compared to like the wood and maybe metal they're using on the tables, they cost such a small amount compared to that they throw this into something called indirect materials. So indirect materials. So how should we allocate this $60,000 of indirect materials to the product? Here's one method. We're going to go through a couple of methods. If you decide, if your company decides, we're going to allocate this based on units produced. So 4,000 chairs, 1,000 desks, 5,000 units. Let's allocate direct materials then at $12 per unit, no matter if it was a chair or a desk. So $12 here and here, desk and chairs. 1,000 desks being produced, $12,000. Chairs, 4,000 chairs times 12, $48,000 of allocated cost. There's the $60,000. So we've allocated this $60,000 of indirect materials to the chairs, $48,000, and to the desk, $12,000. Is that the best cost driver to use? Is the unit a cost driver? That's a matter of opinion. Okay. Let's go down here. What if we use direct labor hours as a cost driver? Not units, but direct labor hours. Well, if we do this, let me see how much I can keep on the screen. I'm not going to be able to do that. Anyway, direct labor hours. We spend $3,500 hours making desks and 2,500 hours making chairs. So 6,000 hours. We have the direct material cost. We're going to use this in just a minute, I believe. We're going to concentrate on direct labor hours right now. So if the cost driver will be hours, 6,000 hours, and we have $60,000 of indirect material costs we have to allocate to the product, then divide, that's going to be $10 per hour. So if we spend $1 on a chair, 1 hour on a chair, we're going to allocate $10 to the chair. If we spend 1 hour on a desk, we'll allocate $1, or really $10 to the desk. Okay. Anyway, here's another way we could allocate the $60,000. Again, this is one way using units if you want to. If you believe this gives you the best allocation method, that's fine. Or you could use hours. So if you use hours and we have a rate of $10 per hour, then $10 times 3,500 hours for the desk, $35,000 now. Chairs, $10 times 2,500, $25,000. So again, $60,000. We don't use both of these methods here and here. You decide what you think gives you the best numbers for your business. Look at the difference though. 35, 25 desk chairs, 12, 48. Quite a change here, quite a difference. So if you believe this one gives you the best numbers, use it. If you think, no, I think this is more fair, allocate the indirect materials based on hours, for each area. Again, your decision. One more option. What if you decide not to use the first two and say, you know what, I'm going to base this on the cost of the direct materials. Okay, so where did this number come from? Let me go back up. Remember, I had this little chart right here. They just gave it to us in step 2. But direct materials cost, desk $1 million, chairs $500,000, $1.5 million total of direct material cost. Let's use this as the cost driver, the allocation base. If we do that, we'll take, again, the same $60,000 divided by 1.5 million direct labor material cost. Gives us 4 cents per direct material dollar as our allocation rate. So the desk, 4 cents times 1 million of the direct material dollars, $40,000. Chairs, 4 cents times $500,000, $20,000. So here's another way we could divide the $60,000. Again, your choice for your company. Which is the best cost driver? It is totally up to you. Now this is just another very similar example. Cost drivers for fixed overhead cost. I believe this example is rental cost, $28,000. They decide to use units. Okay, so if you do this, $28,000 divided by units here, units of the different products they're making, different bottles and so forth, then we have, again, $0.014 per bottle of juice, per bottle, per unit. So if you believe that is the best cost driver to use, then that's fine. Then what you would do then, if you said, well, you know what, of the 2 million units that we produced, we sold 1,000,008 and did not sell $200,000, how much of that cost should stay in inventory at the end of the year, like finished goods inventory, and how much should be allocated to cost of goods sold as cost of the finished product? Well, use this. The 0.014 per bottle, number of bottles, so 2,800 of the cost stays in ending inventory, and we have 25.2 staying in cost of goods sold. What else do we have? What this is just telling you, read it yourself, is just telling you maybe keeping up with the numbers per month is not the best thing to do, because you have months that might have, more cash outlays involved than other months. So you don't want to compute these unit costs per month. Really, you want to do it for the whole year. That's what this example is telling you. So you don't want to get into timing problems. So just estimate it for the whole year, total cost for the whole year. Use the allocation base for the whole year, and that gives you a cost to use no matter when you produce the product, which month. Joint cost. Okay, this is a little interesting area. I have a good little chart here. Let's say you're making a chemical and materials come in. The materials cost $27,000. And to produce it to a certain point costs $21,000. So the materials themselves cost $27,000. Processing cost $21,000. At this point, we have a split off point. You have two products coming out of this point. You have compound AK, compound AL. Okay. Now, compound AK, you can sell that immediately. Sell it for $50,000, cost $36,000. If you allocate it that way, we'll talk about that in just a minute. Gross margin 14. Compound AL picks up $12,000 of the cost. What we've done, we split the 48 to go 36 here, 12 here. So if you allocate $12,000 to compound AL, and you have to process it some more, spend $8,000 more to sell it, and only get $13,000 for it, looks like we're having a loss here. So you're trying to decide, should I, process this compound further and sell it or not? Okay. Well, here's how they divided the $48,000. They decided to do it on a gallon basis. So at this point here, if they have 4,000 gallons and 3,000 gallons is the first compound and 1,000 is the second, then what we need to do is take $12. Well, here's 48 times divided by 4, $12 per gallon. $12 allocation rate times 3, 36,000. $12 times 1,000, only 12,000. So that's where they get those two allocation numbers here and here. So these are joint costs to this point, materials and processing cost. Now two products emerge. We have to figure out how much of this total cost belongs to one product and how much to the other. Well, if we look at that and say, well, wait a minute, if we're losing $7,000 on compound AL, let's just at the split off point, just get rid of this. Just dispose of it somehow and don't get anything for it. Don't process it further and don't sell it. Then we'll save $7,000. Right? Maybe not. Look here. Up here, this says we have a gross margin of 14. Minus 7 here. Let's keep this in mind, because you might think if I get rid of all this from this point on, I'll have a profit of $14,000. Let's look at this. If you sell both products, your gross margin is a net $7,000. You might think, well, where'd that come from? Look here. Positive 14, negative 7. Overall, in this current scenario, a positive $7,000 in gross margin. That's what you have right now. Yes, it's looking like AL is losing money, and AK has a lot of money here, making money. But remember, net $7,000. That's where that's coming from, everything together. Now, if you get rid of compound AL and don't do anything past this point, you've still spent $48,000, and you're only going to get $50,000 in revenue. So you only have a gross margin of total $2,000. See? Without compound L, if you're just selling compound AK, you only had $50,000 in revenue. It has to pick up all the cost because you incurred these. We only had a profit of $2,000. Our profits were lowered by $5,000 because we got rid of what we thought was this loss area here. So what should we do? Now, of course, this is not good. You don't want to drop from a gross margin net of $7,000 down to $2,000. So how can we keep the $7,000? Well, one way you could allocate that joint cost a different way. And if they decide to allocate it based on relative sales value at the split-off point, then you would allocate all the 48 to AK because AL could not be sold at the split-off point. So let me go back up here. If you decide to allocate this $48,000 based on what you could sell the products for at this stage, 0 of the 48 is allocated to AL, all of it is to AK. Now, once you start with the additional processing costs for compound AL, yes, this goes to AL, and then we're going to use this in just a second. So keep in mind this 8. The 48 all goes to compound AK that we could sell immediately. And that's what this looks like. AK, we can sell it for $50, cost of goods sold $48, $2,000 gross margin. But compound AL, we can get $13,000 if we spend $8,000 to process it further, have $5,000 gross margin. There's your $7,000 back. See? Again, we're sort of just playing with the numbers. So here's $7,000 right here. So you either make it look like this, $7,000, positive 2, positive 5, or positive 14, positive 7. Still nets to 7. So you can see you really have to know how costs act, how they should be allocated and so forth, and really know what your true profit is. A minute ago we thought if we got rid of compound AL, then we're not going to have the $7,000 loss. We'll have the $14,000 gross margin. Right here you can see it did not work out that way. It dropped from a net of 7 down to 2 for the entire company. So we need to find a way to go ahead and process AL further, and if these numbers look better to you, more comfortable, then fine. But at least we're back up to a gross margin total for the company of $7,000 instead of just $2,000. Here's an example you can read about disagreement in the allocation base. This is about a College of Business trying to decide how to allocate the copy machine cost between departments. And some people want to use number of faculty, some people want to use the number of students and so forth. So you can read this through here. And it gives you an idea of what people go through to decide what is the best cost driver to use to come up with the best allocation base. And let's see what's next. Now the appendix, don't worry about this too much here, there, and we're to the self-study review problem. So again, that's the main material in this chapter. As always, go back and read the chapter word for word and follow all the numbers through and all the examples. So, good luck with your studies.